Joining me now is Quincy Krosby, Chief Global Strategist at LPL Financial. Quincy, it's always a pleasure to have you here and to bring those insights. I think the cliche goes, or the saying goes, markets climb the wall of worry. So should we be worried about a wall of worry, or should we be climbing it?
Well, the market certainly has been climbing it and doing a really good job in terms of price action. But you can't dismiss the fact that the market has to face, for example, operating margins being affected by higher wages. We heard that in the previous segment. With the revenue backdrop that is going to slow, even at the margin is going to slow. And then you also have at the same time, you've got an issue in the market where perhaps we see credit conditions tightening more, but the stress in terms of borrowing. The large cap names are not going to have any problem, but smaller businesses will, and so will the consumer. And that could lead to even more strain in terms of the market. You know, the first quarter earnings season is going to be very interesting in that we're going to pay very close attention to what they tell us in guidance. Yet again, guidance is most important. Are operating margins coming down at a pace in which they are going to be forced to lay off more workers? So far, it has been minimal. I mean, yeah, we've had tech layoffs, we've had culling within the financial sector, but basically we haven't had major layoffs. If that starts to happen, in order for them to meet their bottom line, you're going to see the consumer slowing down, and that starts to add to that wall of worry. But so far, price action has won, and you can't dismiss it. Still, the Treasury market, the yield curve, is telling us, don't get so full of yourself, price action. We're still here. We still see a recession.
Quincy, I mean, the price action has been behaving or trending that way for months and quarters now at this point. So those indicators in the market have been wrong up until this point. The economy has not fallen deeply into a recession. And a lot of those people who were calling for that are now starting to temper expectations and maybe even saying that a soft landing is possible. That wasn't the narrative 6 to 9 months ago. It is the narrative now. So what in your mind has changed?
What's changed is the resilience of the companies. I mean, every quarter that we've been in, almost the last year, you've had all of these expectations again that it's going to be dire. But it hasn't been stellar, but it certainly hasn't been dire. And in addition, all you need, and we've seen it happen, where companies that come in with weaker expectations, cost cutting has helped, the market has forgiven. And so that's been where we've kind of muddled through. And yet at the same time, we've had some companies actually come in and beat on the top line, the bottom line, and in terms of guidance. It has been actually pretty astounding, especially given the concern that we've had going into the various earnings seasons. The companies have actually gotten through, call it a muddle through, but I'll take that over, a complete downturn.
All right, so Quincy, I want you to stick around right there because we're going to layer another part to this story here. This wall of worry is casting a shadow on stocks here in the U.S., and for the most part, should investors be looking to overseas markets for some better returns? We've seen it. They've been outperforming. But Seema Modi is here with more on that story. Seema.
Don, this is the chart that global investors have been focusing on, the divergence in financial stocks here and overseas in Europe. This margin that we're seeing is the widest margin we've seen in years, despite the collapse of Credit Suisse and the ongoing concerns around Deutsche Bank. 60% of Europe's outperformance this year is being driven by financials and a stronger euro per data trek. And with Germany and France up about 14 to 15% so far this year, Citi analysts are saying that the run is overdone, downgrading Europe today to neutral from overweight, citing concerns around core inflation. However, remaining overweight on China, betting on a second half recovery. We did get some better than expected economic data from China this morning, also upgrading India. But back to China, news of Alibaba and JD.com breaking up, their companies also lifting sentiment. Analysts writing that it could help regulators pinpoint their concerns to specific businesses. Both of these stocks, by the way, are on track for their best week since early January. Take a look at Alibaba, up 18%. The events that could drive sentiment in April. We spoke to a number of strategists. Beginning of earnings season, which is in 2 weeks. We have First Republic on the 13th of April, JP Morgan on the 14th. The next jobs report, we'll be looking to see if there are any signs of a slowdown in the U.S. economy. And on the global side of things, the potential meeting between Senator Kevin McCarthy and Taiwan's leader. If you will remember back in August of 2022, Dom, when Nancy Pelosi took that surprise visit to Taiwan, we did see downstream effects on emerging markets. House
Speaker Kevin McCarthy potentially meeting with Taiwan's leader certainly is another wild card there, Seema. Thank you for that. Quincy, let's take the global part of your title here, global strategist, and talk about whether or not those opportunities in overseas markets do now overshadow or are taking a back seat to what's happening with the U.S.
Well, you know, we've at LPL, we've been talking about developed markets looking very attractive for a number of reasons. One is particularly in Europe. And today we had a really good report in terms of inflation coming down, although we expect to see another rate hike from the European Central Bank.